So welcome everybody. Thank you very much for joining. Pete will be joining us. He's had a little bit of a mishap this morning, but he'll be joining us soon. Welcome to Darren, our resident mortgage expert. Morning, Darren.
Morning, Chris. Thank
Jeremy,
you for the invite.
Always, Jeremy. Good to have you on, and looking forward to this. But I thought we'd break from tradition. A little bit break from tradition. And we're going to ask you first of all about the stock you've got before we go to the Bailey launch. What have you got at the moment?
All right, yeah, sure. A few things, and I suppose it's more relevant as well what's coming up in the next couple of months, just to kind of know what to be talking about, I suppose. There's still some kind of value stock there. There's obviously we've got the Bailey to come with a few units in Birmingham in the Jewellery Quarter. York is still a handful of units there, and they're say one beds under 200 grand. There's some Hull, which is going to be completing in March time. So that's if someone wants a ready to roll project and doesn't like the off plan given current climate, then that's there. And then there's a couple of German prospects as well. There's a couple of Leipzigs. So yeah, there's some stuff to get your teeth into now. But actually, in terms of the coming months, Sheffield is going to be the big one, which everyone's kind of learned to love, I think, in the last couple of years. So we've got higher yields, cheaper, and it's in the city ring road in the centre. It's an existing building, so it's a refurb, which is going to take just under a year, and that will have one beds from around about, well, the cheapest will be just around about 150, but most of them around the kind of 165, 170,000 marker, and then up to two beds as well. But there's about 100 units or so in there, so there's that's a good project to really get going at. Then we'll have Edinburgh. It's a long time since we've done that, but we're really happy to get back into there. I think that's a market which has been criminally untouched, and that's I think a lot of people will be surprised that we've got access to that, and there'll be definitely some interest there. And then we'll be doing some more Berlin again, which we haven't done for a couple of years. So just on the outskirts, there's some more Berlin and more Leipzig to come. And probably a small Oxford scheme, which would be obviously slightly more expensive, more like London prices, but it's 2 and 3 beds there, and that's certainly a bit like Cambridge, a town which has a lot of interest for the certain type of buyer. So yeah, we're fairly stacked to the gills in terms of projects which have exchanged on, and so it's due to launch as and when other things have sold, basically.
Jeremy, I've just got a question that's come straight in. In fact, I know the Christoph's team are very, very up for Sheffield. You got an idea when we might be able to get our hands and launch that?
Yeah, the ultimate question, right?
Sorry.
Look, it could be anywhere between 2 weeks and 6 weeks. Like if how lawyers are and things like that. It basically everything's done and sorted. It's just a case of rolling out the red carpet. So it's there and done. It's just a case of will Edinburgh come before it? So, but soon enough to be talking about it right now, because we know people tend to need to have a little bit of prep time. We can certainly give locations and a price brackets and so forth now, and then once everything's fully sorted, then we'll kind of roll out marketing materials to everyone. But it's definitely worth talking about it now.
Jeremy, just before we get into the meat and potatoes, as I call it, with the Bailey, I just wanted to bring Darren in. Darren, mortgages in Scotland, same as the UK, same as England, I should say, or is it different?
The mortgage side of things is the same, but the process is slightly different. The Scottish laws, property laws, are completely different to they are in England. Once you've offered on the property, it's actually technically exchanged. So what we do is we make sure we apply for the mortgage as early as we possibly can, so that way things like the home report's being checked, the legal pack's being checked. So yeah, but the process is similar. Just means we just start slightly earlier just to make sure everything's okay.
Well, you know what I say, week in, week out. It's always good to speak to you early anyway, on whichever project it may be. So tell us about the Bailey, Jeremy.
Sure. Okay. So obviously this is Manchester. I think a lot of us will know a lot about Manchester, so I don't want to dwell too much on the kind of the groundwork for it, but I'll mention some of it because I appreciate not everyone's an expert on the city there. So big macro view here. Greater Manchester is what a lot of people talk about in the reports and so forth, which is Manchester plus everything around it we see here. So actually that has about 2.8 million inhabitants in it. So that collectively is one of the major GDP output in the UK. Manchester City itself, in the centre there, is actually only about 550,000. That's only about actually the fifth or sixth biggest city in the UK. I think a lot of people assume that Manchester is either second or third, and it's not. But if we talk about the greater, economy overall, this is what we're thinking about. So yeah, the Northern Powerhouse initiative started, around 2010 or so with George Osborne, and so there's been a lot of political pressure to put more business and the regeneration up north. And Manchester has been absolutely the focal point of that. And then, secondary, we're having Liverpool and Leeds and so forth come off the back of it. But Manchester is similar to most cities outside of London. It's the kind of post-industrial era in. They're all manufacturing cities, which became extraordinarily poor through the end of last century, as all that kind of side of industry collapsed. And it's been the reinvention of them and, into service-led industries, which is kind of absolutely booming again. So this is why we're seeing outperforming growth in cities like that. It's because they went down so much and from the 70s and 80s, and only really since 2000 they've started to kind of bounce back, and people start to live right in the heart of the city again. So this is where we've got the opportunity. So working population has increased by 31% since 2000, which is massive. Obviously, kind of that's higher than most other places you'll see in the developed world. And then the centre of the city there, which is Manchester and Trafford and Salford, which are the three kind of boroughs which most people think about as Manchester, basically the inner ring road and a bit just around it. That's expected to have a population of about 1.1 million by 2035. So, a very speedy increase. So everyone's, Manchester's super popular and people are desperate to come and live in the city centre there. And that's perfect for us as investors, knowing that all these tenants and renters are going to be filling up. And so off the ghost of the industrial collapse, this is what's replaced it. So, finance, tech, accounting, e-commerce, logistics, all the industries which are effectively modern industries, which are the ones which are going to be thriving for the next 20 years or so, or longer, the future. The GVA, the gross value add, the money that the Manchester brings into the UK economy, it's grown by 67% since 2000. So it's one of the richest areas. It gives most back, pound for pound, and the economy is expected to produce 56 billion per annum by 2035. So a real player. We're starting to talk about that on a European level now. It was before about on a UK level, but Manchester is a force, and people know it, and people want to travel and visit and work there from everywhere. Labour market, sectorally, we're talking about who's working, what the unemployment rates are, and how much money does everyone have. And you can see here, coming back from 2000, and with our unemployment rate peaking around about 2011, up around about 14%. That's come back down now to about 5.7. But in that time, we can see the average household income has exponentially been growing. So a lot less people out of work, a lot more money in people's pockets, which is exactly the scenario we want, basically, for good, healthy renting pool and competition then for buying property to elevate the prices as well.
Jeremy, I'm just going to give you a little bit of a breather. You mentioned George Osborne earlier on and North Shoring. And for those, you skipped over it very quickly, that was the government's incentive to bring people out of London and go to other major cities, because it was unfair. And especially with the global financial crisis, London was affected. So that's what they went about doing. And that's why you've got the BBC, HSBC, head offices now located up there. And that's where the tenant pool is going to come from. So it's really important to notice that Manchester is just going through the roof, and the shortage of property up there creates a supply demand imbalance. Jeremy, back to you. Just thought I'd put my two pennyworth in.
Just very quickly, Chris, I don't know if you can hear me. Kaprinka and I are here now. We had a little technical issue at the hotel and we couldn't log on. Vincent very kindly got it through onto WhatsApp, so we've joined via WhatsApp now.
Oh, welcome. Thank you. Jeremy,
All right.
back to
Well,
your graph.
yeah, and I suppose that when you talk about the North Shoring, effectively what the government's doing then is de-risking the UK. It doesn't mean all your eggs in one basket in London, and so that's a vital thing for the whole country basically in future, that you've got many different cities which are really interesting and attractive for people around the world to come and live in and go to university and invest in, and it's been working extraordinarily well. It's well timed on kind of matching the growth of these markets, and yeah, it's helped a lot. And certainly with Brexit, when suddenly London didn't look like the most attractive market because it was expensive and low yield and people worried about prices, suddenly Manchester had 2% higher rental incomes and a lot cheaper prices. It's been a lot more attractive to invest there, and thankfully it's the numbers stack up. So here, this graph here shows essentially the difference between 2010, 2021, and then looking to the future of 2035 about your average household income. So what we're really seeing here is, in 2010 there you can see the dark band is houses which had an income of over collectively 100,000. And that was not many. And by 2021, that's increased by 246%. And it's looking to increase again by another almost 1,000% by 2035. So partly this is inflation, of course, but this is a massive outperformance. So your average household basically has a lot more wealth than they did historically. And this obviously all feeds into the health of the economy overall, and then obviously then the housing market and
Jeremy,
renters and
can I
buyers.
just cut in there? Can I just cut in there a second? The other thing you need to take into consideration is that wages in this country rose by an average of 6.7% last year. So although we've got the headwinds from inflation and obviously mortgages, which, as you've rightly said, are now starting to peak and come back down again, but the general wages rose by 6.7% last year. So it does go towards costs. So it's not as bad as it may appear.
Yeah, absolutely. I feel like we're in a situation kind of right now where there's people either sit on one side of the fence, they see the opportunity of the market and the fact that there's opportunity. We've still got a good currency play for particularly our investors based here in the Middle East and related to USD. Or the people on the other side who are just a bit worried about the extra expense for their interest. But that really is it's a short-term cost basically. And if you're thinking about the kind of being £150 negative on a monthly basis, opposed to the the possibility of getting 10% discount on the whole property for currency exposure, then you're kind of missing the point really. So I think part of our job is to help people see the bigger picture, and the actual opportunity is there for a lot more money to be made, and even if it costs a smaller amount over the next year and a half with higher interest rates.
From what I've seen as well, I've done a bit of research on the Bailey, and I think that it's well priced. So therefore, I think that part of that potential drop in value has already been factored in. And I think there's talk about there being maybe a 9% drop in prices across the UK. But looking at the prices on Nimbus, which I do, it appears to be that perhaps there's a maybe 4 or 5% has been factored into your prices anyway. So I think we're in a good place with it.
Yeah, 100%. And actually, as a strategy, we've been very much, looking for refurbishment projects in the last 8 months or so, just because, the supply chain, the materials cost for developers for new build, it's gone up 25% in the last year and a half. So projecting your costs, they have to put that on the end values. And so we can see some new builds are going to be affected by that. So very much, we wanted a project which doesn't have your wood and your steel costs, which kind of have to be loaded up onto there. And actually, really, it's just fit out. So hence why, it can be a nice, short, low risk build time. And, we don't have, this is it. It's a value play. And we'll see that in the pictures and so forth in a bit. Education kind of speaks for itself. This is having this kind of young talented market, and there's about 100,000 students in Manchester at any given point, and that's a massive amount, and that's good for retention of talent. These kind of people these days in Manchester tend to stay, which maybe 20 years ago they'd all leave and go to London, and so this is a feeder basically for your success in future years, and some of these universities are in the top ranked ones in the UK. Then regeneration. I don't need to spend a lot of time on that. Really, as a visual representation here, I just wanted to put it up in terms of there's so many regeneration projects going on Manchester, and some of these are on massive scales. We can see here in terms of the spend. You know, £1 billion for St John's, Enterprise City, the Factory, Noma, Circle Square. Some of these have started a few years ago. Some of them are kind of just starting up now. But we're talking about London money with this kind of level of regeneration spend. You go nowhere near this in most other cities in Europe or in the UK. And that's a massive reflection on big international companies and developers' confidence in this city to keep performing. So I think that's the kind of thing you need to translate to your buyers, basically, is to, this isn't a conjecture, this is stats, this is facts, this is happening. So it gives a lot of confidence. So yeah, housing market. So we know all these people are coming. We know they've got more money in their pockets, and we know that all this enterprise and everything is going on. And yeah, with all the best will in the world, and you would be forgiven for thinking that they'd be oversaturated with property, the amount that's built there. But over the last decade or so, only 34% of the required housing has been delivered, which basically means the problem of supply and demand, which is the absolute bedrock of all good property investments, is actually compounding. It's getting worse over time. So for us as investors, it's brilliant. They can't deliver the property needed, so the competition on rent gets tighter, and the competition on house prices get harder as well. So even with a high estimation of what can be delivered, they're not going to hit 50%, and not even the next decade. So yeah, this is set to continue for some time. And here we see our projection up to 2031 of 82,000 homes deficit in Manchester, which is a lot for a city that size. So the property itself, I just want to show you this picture. So we're I don't know if you can see can you see my mouse here?
Yep, we can see it.
This is a scheme as it stands, and this will be the one that's being refurbed and regenerated, and just give an impression basically of just how close we are to the city centre there. That little cluster of high towers there, that's around not Gateshead, Deansgate, and which is a bit like Manchester's Canary Wharf. In the last kind of 8 years or so, this has been springing up. So some of the biggest, fanciest residential property that's in the city there, and it's just on the outskirts then of the major employment sectors. So yeah, we can see here we're just a hop, skip, and a jump basically. And I'll show you a little bit later on a map. I'll try and translate to Google Maps, and we can just see just where it's nestled basically. So we're just in the triangle here basically of the city centre, which is one of the major employment hubs, the major university alley where you have the university buildings and where a lot of the students will live, and then Trafford, which is the largest industrial park in Europe, and actually increasingly one of the more developed residential neighbourhoods for the city. So
what is that building now, Jeremy? When you put your cursor on the Bailey, what was it, or what is it, and is it empty now?
It's empty now. So basically, it was a residential building. It's one of the I don't want to go into the whole history of that, but obviously Grenfell in London, the tower that burnt, made cladding issues around the UK, and lots of properties weren't fit for it. So effectively, they exited and got everyone out of the building. They're recladding, repurposing, getting everything up to spec, and completely redoing all the interiors to make this a shiny new build. So this property wasn't that long ago in the making. We're talking only 15, 20 years ago or so before that was originally constructed. And so this helps in terms of the value, which means that we can be at actually the cheapest two beds here around about 340 pounds a square foot, and then going up to probably the highest about 410, 415 or so. So that, for perspective here, and this is what we're talking about value, those shiny towers there, just a 5-minute walk away, the two beds in there are probably being sold for 450 to 500,000 pounds, whereas our ones are around about 280,000. So, and then even this strip of buildings on the left here, that's fairly established just by the canal there. Two beds on higher floors there. We had a project there last year, and they were selling for 380 to 410 for two beds there. So this is why we're getting here now. It's an opportunity, a timing play to get into this pocket of what is a lot of it around it is established residential that was built in the 1950s and 60s, but it hasn't been touched since then. Right on the doorstep of the city centre at much more attractive prices. So if people want to make money, see price growth, and see good renters, this is what you should buy, as opposed to your fancy shiny towers, which invariably will rent well, but you're not going to be able to see the kind of growth there because you're buying at such a price already. So there's a lot to talk about with one picture. So a little bit more. This is kind of a CGI of the internal courtyard there, as we're expecting it to be, and then a few on the exterior. So it's mostly all 2 beds in this property, ranging from cheapest at 249 going up to 314. Couple of 1 beds at around 237. It's going to be completing towards the end of this year, so not long. So only 20% down as a deposit now, and then then November time will come to completion. And Darren, what we'd probably expect with November, what kind of May time to kind of start with ball rolling on mortgages?
Yeah, it's a good time to start.
And helpfully as well, because we're probably in the eye of the storm in terms of mortgages and interest rates at the moment. They kind of overcompensated at the back end of last year when all the banks raised their rates. And actually, even if the Bank of England base rate still goes up this year, actually the general consensus is incrementally we'll see rates kind of going down and more banks getting competitive. I mean, wouldn't you say, Darren, is that kind of fair to think?
Yeah, we've had one of the big expat lenders reduce their rates again, so they've reduced them just before Christmas and again now. So, but like you said, Jeremy, they all increased their rates probably just to stop lending, if you like, and now they're realising they've got to lend, so they've started bringing them down. But just one point on that payment terms come up a few times on a few of these shows, and Chris will back me up on this. 20% on exchange, great. 80% on completion. That doesn't mean you're going to get an 80% mortgage going forward. So it's going to be anywhere between 65 and 75% maximum, depending on the lender and the client and their situation. But realistically, between 65 and 70%.
Thanks, Darren. Jeremy, just going to pick up on that. You've literally only got one bed left.
Actually, one bed in the entire scheme of 104 units, just the way it's designed.
That's good.
That's the only one for sale at 237.
Yeah. So think of it as a 2-bed scheme.
Okay, all right, but there is that 1 bed there. Somebody wants it.
Exactly. It's there. So exactly, rush. But actually, in terms of what we found, a lot of our other projects, yes, of course, 1 beds are slightly cheaper, but in terms of the rental side, your eventual prosperity of the project and so forth, we tend to find that actually 2 beds tend to be a bit more liquid. They tend to sell easier, and they tend to get slightly higher capital growth over a 5 to 10 year period. So actually, if you can afford that price, this is the kind of thing you should be going into. 2 beds, do rent well.
It's fair to say as well that the growth in the rental yield, we're looking approximately 12% in 2023. That's what's being suggested. So very nearly a 1% a month. And I've said to people before, I've got 102 apartments down in Southampton, and every time a void comes up, we're managing to just put another £75 a month on, and it's gone in a heartbeat. We have no voids. So I think you're going to see a strong income over this next couple of years because there aren't available properties. So
yeah, less developers are building because it's a bit riskier in terms of the costs. So there's less people committing to schemes. They're being a bit more cautious of it. There's more people who are not buying, basically. So there's a much higher demand for renters, basically. So this is it. We'll probably see.
I call banks umbrella shops because as soon as it starts raining, they take their umbrellas back, and so therefore the developers are not managing to get the funds. So schemes like this are more assured because they're not taking the developer risk. Trying to get straight senior debt or senior debt within the development side of things at the moment is really difficult. So they're sitting on their hands. That's why a project like this is perfect because it's de-risked.
Yeah, quite. And actually this is it. You see developers asking for 30% on exchange up front. That's one of those little signs, isn't it? They're probably, they're using the deposits as the build cost rather than having development finance. So, you want it is, 20% max basically. And that's probably the best advice I can give on that.
Jeremy, I'm not quite sure if you've got another slide, but I just want to somebody just asked a question. Reservation fee is.
Yeah, there are a couple more, but I mean, I actually what I can do is I can flick to Google Maps and we can just show the area and so forth. Let's see if there's anything more pertinently to show. All this is available from our Dropbox and so forth, or it can be if you want to. I can send it to Chris to resend out to people afterwards as well. All the different.
And this recording will be on the website, which is holbornpropertyinvestments.com, along with other award-winning shows.
Yeah. So yeah, the reservation fee is £2,500.
Okay.
And then that can be refunded on completion, rather than be part of the deposit. So because that comes to us as a company, as we're the underwriters basically. And so when they complete on the property, we'll refund them after. So they can use it for setup with their letting agent and so forth. Mandale is a developer who we've been very successful with. We've done maybe 7 different projects with them thus far. Arc Avenue there, I bought one of those last year in Newcastle, and that's done very well. And the rents have been up 125% of what we expected originally. So they do produce on time and very well, Mandale. We like them a lot. The other thing, just in terms of it's useful for everyone, in the sales side of this, is we've got an incentive here so that if your clients reserve, if they can exchange the properties within 28 days of reservation, well, actually not of receiving their legal pack from the lawyers, then we will refund their reservation fee after exchange, and we will pay £1,000 towards their legal fees. So it's just good business for us. It makes things really quick. It means that everyone gets paid quicker and on time, and it's just and clients love it. They get an extra £1,000 off. So bear that in mind for this scheme.
I tell you what, you just touched on something, and I really want to drive this home. We're dealing with IPG. You are different from some of the other partners we have. You touched on it very quickly, and I don't want you to go on for too long, but just in 30 seconds, underwrite. You're the only ones that underwrite. Can you just explain quickly in 30 seconds what that actually means and how it de-risks the client? No, you didn't want to do that. No, you've gone mute. Well, I'll tell you how it works. That's even better. So what IPG do, they have, and I hate the expression, but they have skin in the game. They actually commit to the developer the number of units they're going to actually sell on. So it's not as if they've got no skin in the game or they've got they are actually putting down real pounds, shillings and pence. I think you're still muted, Jeremy. Anyway, there's a map of Manchester there. I'm going to have to wing this, aren't I? Now I'll tell you what I'm going to do. Whilst Jeremy does that, I'm going to change the subject to something really important. Oh, he's back. I'm going to go back to Pete. Pete, it broke in the press yesterday. Exciting news about Holborn. And I just wanted you to just say a few words about our new partnership with Centric.
So Centric are a company based out of Birmingham. They've got 220 people working for them. What we've agreed is a full property service. What we're trying to do is to improve the service to the Holborn clients. In the past, perhaps we haven't given the best of service. Part of that is because everything was fragmented. Lots of different companies looking after property management, and likewise even with legals. We had a situation with a company that will remain nameless at the moment. They came back to us and said, by the way, we're not doing conveyancing anymore. Well, what about the 9 clients you've taken the money from then? I said, well, we're not doing it anymore. But you can't just do that. Well, we have. And so what we're doing is we're now going to make a robust 360-degree system where we're going to be using Centric to carry out our property management, but they're also getting involved in making sure the DD is completely robust in terms of ERVs and incomes, etc. So, I mean, obviously, a company like IPG, they do all of that as well. But we're trying to make sure that we don't have some of the problems that we previously had. It's so great news, strategic relationship. It's announced, and literally within the next 2 weeks, we're going to be using Centric to carry out our property management. And we think that's the right thing. But also, we're going to be going over to Clark Wilmot as lawyers that will be doing all the legals, because we're not prepared to have a situation where regional lawyers can just decide they're going to down tools and take money from people. Clark Wilmot are a large company with over 200 lawyers working for them. So that'll all become completely clear in the next couple of weeks. But sorry about that, Jeremy. We cut in because we lost you. So
yeah, no worries. I was trying to shift getting my mouse on board. It's cut out the audio device I've got. But anyway, I won't go too much detail with this. It was just really to give a bit more of a visual representation for everyone about, you know, Manchester and, you know, where we are positioned here. So these orange stars here, basically, these are the Manchester projects we've sold in the last, you know, 5-6 years or so. And actually, I suppose it kind of shows a bit of a story itself, really, in terms of the interest in where we've bought. So we actually started in the city centre here, around Chinatown, and then these three in the middle, and we were buying at £350-380 a square foot back in 2016 there, and then up to the northeast, going up to Oncoats and Northern Quarter and so forth, and then more latterly, kind of drifting then into Salford, and then going down into Trafford here. So this road, basically, there's been a lot of development basically on the residential side that's going out there, so that's becoming a really desirable place to live. So yeah, and we've moved basically with the value. You know, we don't want to keep just buying in the city centre just because it's a city centre. We want to get it so it's got potential for growth. And so, you know, as we said, like the properties down here now, it's very hard to find new build under £550 a square foot. Well, you know, it was only 6 years ago that we were selling for 350. So it's difficult to see that growing again in the same capacity, but it isn't difficult to see it happening just next door. So here for this, this is the what's called Lawrence House, but yeah, now called the Bailey. We're just a few minutes walk from the inner ring road, and here we've come anywhere from 350 to 410, depending on the unit there for value. So it's nestled this whole stretch here. That's where the University of Manchester is, and this mile down here, that's where a lot of people will live. And you've got the major city centre, and a lot of the employees here are the blue tabs of different employers. So Barclays Wealth, Klarna are a big fintech company, Arapa a developer, BNY Mellon on finance, Booking.com. So that, you know, there's lots of really big brand names, Kellogg's, and of course we've got the big football clubs as well, which add lots of employment to the area. But I just wanted to kind of give a view of just how close we were to all the action, but having been a much better value. So even just across the road there, that's going up to, you know, 450 a square foot, and then up to 550 to 600 just inside the inner ring road. So if people want to buy and hold for 7 to 10 years and make money, that's the kind of price in this area you should be buying at, as opposed to the slightly, even if it's flashier, you know, not better looking buildings, I dare to say sometimes either. This is what you should buy if you want to make money.
Jeremy, a question's just come up. Did I hear only one? Cheat has obviously tuned in all of a sudden. Did I hear only one unit left at 237? Can we see the unit on the plan? Well, we won't go back and do that now, Jeremy, but we will. Oh, you are going to do it now. I just forget how good you are technically. But we will reach out to it. There you are. There you are, G. Well, that's for a service. Extraordinary service. But we will get out to you, G, anything you need, as we will with anybody who's on the show today. Sorry, did I cut across you there, Pete?
No, that's okay. Would you agree, Jeremy, that people need to understand that property is a medium-term game, not a short-term game? So my view is that, and I've been in this for 35 years now, property, if you advise clients that you're looking at an average of 3.5% per annum and then amortize it, you won't be far wrong. So no different than last year, we also a rise average of about 12% in the UK. It can't carry on at that rate. So, okay, it's flattened back a bit, and we've said it's already been discounted off of that high. But over any 10-year period, I think if you're looking at 3.5% and then amortize it, you know, you're going to end up effectively over a 10-year period. What would you suggest, Jeremy? But certainly you're going to make, what, 60%?
Yeah, absolutely. And obviously, this is going to change a lot in terms of people's kind of expectation for growth and so forth. But also, I think we've got to get our realistic hats on as well. I think, there might be a few clients you speak to who are a bit behind the times in terms of their expectations. Like the whole world's going through an inflationary period where, frankly, if you're going to sit on your money, you're going to be losing 10% of it per annum. So, the step one, don't lose money. So put it into an asset which is going to hold value. And so, for people who are going, yeah, but I really want to find 10, 15% growth per annum, it's like, well, you're talking 2020 or 2015, like this is not the current world as it is. Keep your money safe first, then look for kind of sustainability and growth. And property as an asset class, of course, it's more work, of course, it's a longer term thing, but illiquidity is a slightly dirty word in terms of some, investments for some people's eyes, but that's what keeps this safe. Properties can't be traded and flipped in seconds. And so the whole market is based off supply and demand. More people want to vie and compete for this property than is available. That's the only reason why it goes up, not through speculation and, the wind blowing, which is also, I suppose, I don't know how many people on this call are global or how many are based in where we are in the Middle East, but particularly in the Middle East, that's the opposite. The property market in the Middle East here, people are saying, yeah, I might buy in Dubai. It's all on speculation. The last year's boomed because, whisper it quietly, billions of Russian money's coming to market, and they're one of the only countries in the world will accept it. So, like after that fades down, we're going to see, drops again. So it's not based off supply and demand; it's based off speculation.
We're going to have a great come up shortly, Jeremy. What I'm doing, I'm going to buy the Isle of Wight and I'm going to turn it into a tax haven.
Well, that would work too. Yeah.
Jeremy, I'm just going to. Darren's there, sitting there patiently. You came in earlier on, but state of the market, and I say this every time, and I make no apology for it. Speak to Darren, speak to Donna, whenever you like, with regard to what your accessibility is to mortgages. Speak to them first. Get what we call it DIPT, decision in principle. Darren, over to you.
So yes, the mortgage market is actually really good. Lenders have started coming back in with some really interesting rates. Like I said, a couple of the big lenders have started reducing their rates down, and actually the stress testing is reducing as well. So last year was a little bit tricky, where lenders not only increased the rates but actually increased the maximum loans based on rental figures. So it's good to hear that Jeremy and the company is obviously doing lots of due diligence regarding the rental figures, because that sort of had a little bit of an impact in the market last year, where lenders were getting a bit worried about rents. But like Pete was saying, rents are actually going up, which is great news. And lenders are understanding that. So their stress testing and the rents mean that they're actually lending a lot more than they were last year. When I say a lot more, sort of 20, 30 grand sometimes, doesn't seem a lot, but actually in the scheme of things, it means that somebody can buy a 240 a 2-bed as opposed to a 1-bed at 236. So it is making a massive difference, which is only encouraging to see.
That's great, Darren. One thing I wanted to say, and make no apology again for being back in Manchester. We were in Manchester 2 weeks ago, where we launched a completed project, completed and rented. Bailey, that's the end of this year. Jeremy?
Yeah,
did you say the last quarter? So we've got some good choice there. I mean, I'm bound to say we've got York, we've got Brighton, we've got other parts of the UK. So those that are in there, thank you very much for joining. But if there's anything you need, let us know. This will be on our fantastic new web. Pete, anything more you'd like to add from your car?
Just to say that I think that Holborn property is really starting to uplift. We've got a lot of support from the board. We've got some other new and innovative products come in that are not residential, which we'll see very shortly. So we've managed to address an awful lot of the legacy issues. That's good. We're now starting to see some of our big hitters come back. There's one or two people that down tools because of the situations, and we understand that. But we've now resolved, I would say, 90% of them, and we're working on the last 10%. So it's a totally different ball game now.
Just got a quick question in. Sorry, Alistair. Thanks for jumping on. What's the expected rental on a 2-bed, Jeremy?
Probably
on the spot.
topping over about 1,000, I suppose. So we're probably kind of like mid 4.5% or so. Look, I think our investment team tend to be brutally cautious with these things, and like Pete was saying, I think this year is a massive bumpy year for rental income rises. So I would absolutely not be surprised if it's a lot higher than that at the time, but I don't. We never overpromise. We literally look at what's available in the same area for the same property right now, and we'll put that. It's probably going to be higher, but it's it's a healthy market, and it's one that, because it's going to be the nicest property and it's given a few hundred yards area, it's probably going to rent pretty well for that.
Thanks, Jeremy. Thanks, Alistair. Good question. Right, I think we'll wrap it up there. Thank you very much. As I said, all webinars are on our website. Look, thanks a lot, Darren. Thanks for insight. Thanks for stopping in a late by Pete with Caprinka. Jeremy, brilliant as always, and thanks to marketing putting it all together. See you again next week, Property Thursday. I'm going to get a theme tune by next week. Thank you very much. Bye.